Welcome to this session, How Launching or Growing an Endowment Leads to Organizational Resiliency. My name is Katharine Earhart, and I'm a founder and partner with Fairlight Advisors. We help small to mid-sized nonprofits launch their first endowment, and we help some improve their existing endowment or board fund process. We also offer a variety of financial consulting tools that can help nonprofits maintain and achieve financial resiliency. We've developed this training because we found that many nonprofits think, oh, I'm too small to launch an endowment, which is a myth. Or they think, how hard could it be? I'll just put something together, we'll go out and fundraise, piece of cake. Not quite exactly like that, but they think it's a little less involved than it actually is, which, is a myth that it's easy. But, you know, launching and managing an endowment for the long term really takes time, resources, and patience. But the dedication is totally worth it for your mission and for the communities that you serve. So before we dive in, let's take a look at what we commonly hear about endowments or quasi-endowments. What comes to mind when you think about endowments? We often hear phrases or words from nonprofits, especially small to mid-sized ones, that feel they don't have the size or the donor base to have an endowment. We often hear, oh, I need a big fundraising team, or I need lots of donors. Or, I'm going to have to think about long-term investments. And is that right for my organization? I don't want to have a liquidity crunch. I want to be able to have money in reserve, things like that. Or we hear, oh, there's a lot of restrictions around endowments. While that it can be true because it is based on donor restrictions, you could set up a board designated fund, which has fewer restrictions. Or I tend to associate endowments with scholarships or, only wealthy donors. Sometimes we hear the phrase sustainability. Some organizations think, oh, okay, an endowment is for the long-term sustainability of the organization, which is true if it's set up correctly. Or endowments are for hospitals or really large organizations. It's not necessarily for, my smaller or mid-sized nonprofit. Or it takes a lot of money to launch one. I don't know if we're going to be able to do it. Or it's really only for foundations, right? Because they're grant makers. But the answer is not necessarily. And there are opportunities for smaller organizations to launch endowments. Let's take a look at the endowment landscape. First, we believe that all nonprofits trying to expand or scale impact should strive to launch an endowment. Not only is an endowment a practical tool that gives organizations greater financial resources, it's a sign to the public and your prospective donors that that your organization it has meaningful financial to support to fulfill its long-term philanthropic mission. It demonstrates to prospective donors that this is a nonprofit that can weather economic fluctuations and continue to fulfill its mission in hard times. And, the fact that a nonprofit with an endowment could potentially support core programs for an extended period of time, that's encouraging to prospective donors for further donations. So it's sort of a self-fulfilling prophecy of I've got an endowment and therefore people think I'm able to weather an economic storm and support core programs, and therefore it's going to raise more money. We'll talk a little bit about this later in the presentation. And in this time when government grants are being rescinded, foundations are pulling back, or, we're having to find larger long-term sources of funding that can actually attract additional funding. So, like the slide says, an endowment encourages other donors to contribute. Now, let's look at the endowment landscape. The news tends to focus on the endowments of higher education, but a study by MIT's Sloan School of Management took a large sample from some 2 million nonprofits in the US, a sample of over 300,000 organizations and projected about 11% of those nonprofits had some sort of endowment. The study showed that nonprofits with an endowment had 6 times the value and assets of nonprofits without an endowment. 6 times. In other words, the average value of assets of a nonprofit with no endowment was about 10 million, while those with an endowment averaged over 60 million in assets. So I've shown here different nonprofit sectors and the average size of their endowments. The highest by far, which is not even on this chart, is higher education, which averages over 250 million, thinking Harvard, Stanford, Yale, etc., and hospitals at almost over 40 million. However, the study showed an average endowment size of 20 million for these other sectors. And then within these sectors, nonprofits have different average sizes as well. So in the human services, it's about 4 million. In the arts, it's about 10 million. Health, about 7. Environment, 5. The political, or sorry, the public and societal benefit is 13 million. And then we've got 21 million for education. And that's excluding the higher ed stuff we were speaking about earlier. I hope these numbers encourage some of you to launch your first endowment. You may be thinking, oh, 4 million seems like such a long way off, but sit tight and we have some encouraging stories for you and some examples. So let's back up further and define an endowment. Endowment is really a pool of funds or assets invested for the long term or invested for a set time frame to support a specific project or general operations. Spending from the endowment is usually fixed over the duration. Endowments can be simple or complex. However, there are typically 3 types of endowments: a true permanent endowment, a term endowment, and then a quasi or board designated fund. So let's kind of dive further into the endowment types. A true permanent endowment is restricted by a donor to support the organization indefinitely. And they're restricted by a donor for a specific purpose and are meant to support the organization indefinitely. There are laws that govern true endowments in that the donor intent, whether it's how the endowment is spent or how it's invested, supersedes anything else with respect to the endowment. The money must be spent and it must be managed prudently. A term endowment is really restricted. It follows the same regulations as a restricted endowment. However, there's a time element involved. It could be for a set number of years or after a specific event or when the endowment has grown to a particular size. Anytime you have a restricted endowment, it is critical that you have written donor guidelines to keep the organization compliant with endowment laws. And it's very important to have donor contracts too that specify the donor intent because that donor's money or gift is going to outlive many people in the organization and even the terms on the board. And then, of course, the most flexible endowment is the quasi or board designated fund. We prefer the term board designated because it better describes what this pool of money is for. A board designated fund is a pool of assets that is unrestricted by the donor, but it's restricted by the board to do with the funds that it sees fit. So it differs from other unrestricted funds in that there are policies and procedures in place to govern the fund. And more likely than not, it supports the organization in the long term. So it's not a reserve, it's not a rainy day fund. It's really meant for that long term. A board can decide to change the mission and spending of a board designated fund, which makes it very helpful in a nonprofit's long-term viability. And why this one is our favorite is it also, or often, a launching point for nonprofits looking for a major donor to seed an endowment. Many wealthy donors want to see a nonprofit establish a board designated fund with a set strategy, policies, and procedures before they're going to write the check. I was on a board of trustees and we were doing a major capital campaign. And the board decided to set aside a board designated fund to really seed both the capital campaign and the endowment. And it was magical because, of course, after the campaign started, it was in the quiet phase. They were able to secure some large donations as well as some contributions to the endowment, which was great. So let's look at the anatomy of endowment. We wanted to share an amazing story of a 30-year-old private school with a budget of around 20 million in 2022 that wanted to formalize their endowment and board designated fund, as well as increase the size of their tiny endowment. They had some small restricted gifts, but nothing that was really game changing. So they decided to seed a board fund, designate a board designated fund with $350,000 of funds they didn't need immediately and that they were hoping would attract donors. So keep that number in mind, 350,000. So let's start with some vocabulary around endowments. We call the funds invested in an endowment the corpus. In the example we gave on the previous slide, the school's endowment or board designated funds corpus would be 350,000. The organization, you know, typically any organization strives to protect the corpus as much as possible when they are launching a permanent endowment. However, it's not always possible because, as you will see in the next slide, investments selected for in the endowment are for the long term. They do fluctuate in price. The value of the endowment can go below the corpus, as you see here from sort of May of 2022 when it went up to 361,000 to, towards early July of 2022 when it dropped below the corpus to 332,000. And that's typical for the first few years of launching an endowment. That's why so many endowments or board funds really hold off on taking any money out for 3 to 5 years so that the endowment can establish itself. Just like a garden, when you first do the planting, you don't want to harvest it right away. You want to give it time to regenerate or grow bigger. Think of fruit trees, maybe 3 to 4 years before you're really taking the fruit off the trees. It's the same with an endowment. So for this particular board fund, the market value went up temporarily, as we mentioned, and then it dropped. And we call this up and down experience that's like a roller coaster, we call it volatility. A great way to show natural volatility is to show you the, last 100 years of market crashes. It's market crashes are defined as 20% drop or more from the market's last peak. These drops are typically temporary. Think of '08, the market started to climb back. I think it reached its bottom in sometime in March of 2009 and then, came back from there. Even if it's a very distressing time, in that moment, just like it was in 2022 as well, that sort of slow decline down as you're watching assets drop. History shows that the markets tend to recover over time. In fact, if you were able to invest at the peak of the market in 1929 and you rode out all the crashes, so think of all of those: Vietnam, Watergate, Black Monday, Cuban Missile Crisis, credit crisis, COVID-19 pandemic, all these things, and you adjusted for inflation and you reinvested the dividends, you would have a return of almost 42,000%. Yes, 42,000%. So let's talk about what securities are in a simple or small endowment. Usually they include two types of investments: stocks or equity, as people in the industry call it, which represents ownership in a company. If you own Apple stock, for example, you own a little piece of Apple, the company. And yes, it's little because the market cap of Apple is quite large, but nonetheless, you own a little slice of it. The other type of security is a bond, or as the professionals call it, fixed income. Bonds are a loan that the investor is providing to the company. So again, if you own an Apple bond, you are lending money to Apple, the company, in exchange for a stream of interest payments over the term of the bond. Most stocks and bonds can be traded on an exchange, and some are negotiated between parties. They can be offered to the public in that basically anyone can buy it, or they can be traded privately between institutions like nonprofits may do, or certain wealthy individuals. The more complex securities are more appropriate for larger endowments, but simple publicly traded securities are best for small and mid-sized endowments. However, even some of the endowments that are in the billions really choose to invest in simple products because the returns are the strongest at that lower cost. When you start to get into complexity, the fees go up. So how do you calculate the value of an endowment? Just like your IRA or 403(b) or any other pool of investments, we really look at the itemized list of securities in the portfolio. And based on the strategy, each security has a certain percentage allocation, and each has a price. So I've flagged on the left-hand side of this chart which funds represent stocks and which represent bonds. And then for this highlighted piece here, we multiply the amount of the security, and here it's, a percentage holding, but it also could be the number of shares. And we multiply that by the prevailing market price, which then equals the market value. Then we add up all the securities in this portfolio, and that equals the total market value of the whole portfolio. So let's continue to stay with the anatomy of an endowment, and we're going to return to our school's board designated fund. So our school's fund, remember, was seeded with 350,000 in May of 2022. 2 months later, a major donor decided to write a $1 million check. And then 4 months later, they got another $1 million donation. And then in 3 years after that, they got another $1 million, or 1 year later after that, they got another $1 million. So in 3 years, the board designated fund, grew from 350,000 to just 3.35 million in 3 years. So that's pretty amazing. Now, if you include market value, so the increase in the total portfolio, it was about 4 million. This shows the power of seeding your own endowment. It starts to attract other donations. Now, this is a remarkable story, and the speed of donations is not typical. However, the increase in the market's not always typical, but the experience of attracting donors and increased value over time is typical. It all depends on how effectively your organization uses the endowment in its fundraising activities, and then the prudence of its investing strategy can really help push the mission further than it might without an endowment. So let's say the organization has the funds for an endowment, either through a large unrestricted gift or accumulated net assets or profits. What do you do now? Now what? So first, the question to address is, what program or operational expense will the endowment focus on? This really helps clarify the endowment's purpose and ensure it aligns with the nonprofit's core mission and strategic goals. A well-defined focus allows for targeted impact and prevents the dilution of resources across way too many areas. This is much easier with a board designated fund, which is flexible, right? Depending on, what's going on in the organization or what's happening with external events. A true restricted endowment is not as easy because leadership really needs to negotiate with the donor about what program the endowment will support. This is very critical with restricted endowments, more critical than a one-time gift, actually, that might be spent over a shorter time, right? This is a long-term gift, a long-term endeavor, and the organization really wants to see this money sustain the organization for a long period, if not indefinitely. And if this isn't thought out effectively, it could severely restrict the organization. We've seen situations in which a donor puts such onerous restrictions on an endowment that the organization couldn't spend the funds, on its most critical needs. So next, let's look at, ensuring a sound budget and operating revenue. Um, accurate budgeting and financial forecasting are essential. Nonprofits really must anticipate how much they'll spend from the endowment on their programs. So doing that level of financial planning is key. They want to know how much they're going to spend so it doesn't compromise the principal. And you really have to effectively manage it and have oversight. That's crucial for maintaining the donor's trust and ensuring the endowment serves its intended purpose. So we don't recommend launching an endowment or a board designated fund without having a fully funded operating or emergency reserve. You don't want to be touching your long-term money so soon after establishing the fund in the event of an economic downturn or an unplanned expense to the organization. If your nonprofit doesn't have a budget, it's really hard to project how much would be needed if the going got rough and you needed to pull back on your board fund plans. Donors don't like to see that. They don't want to see that an organization wasn't prepared for natural disruptions. So they want to see that first, then seeding the endowment is the second thing they really want to see. So the important thing also is having an oversight team in place. An endowment needs stricter oversight from staff and the board than any other financial, than anything else financial. And we'll get into that shortly. The other thing you're going to want to do is craft the investment policy statement, or the IPS as it's known. It's executed by the board to establish the strategy and rules that govern the endowment. This is required for a restricted endowment and very important for a board fund. So why does your finance committee really need to step up? What's critical about that? We mentioned before that an endowment or board fund both need an oversight team, and most importantly, they need a strong treasurer or finance chair. The treasurer typically has the following responsibilities. So they need to maintain the financial accounts. Now that's delegated to a staff member like the director of finance or the CFO, but the treasurer is responsible for the oversight of that person's activities, including a budget being created. And that treasurer must also oversee how far off actuals are from the budget. That's very critical too. They're also The treasurer's also looking at whether the organization is publishing financial reports, the statement of activity, cash flow, and balance sheet. When it comes to launching an endowment, you're looking at whether the organization has the liquidity to really launch the endowment, as I mentioned before, and it can pay for unexpected expenses or survive a prolonged drop in revenue. The treasurer also maintains all the appropriate fiscal policies and making sure they're adhered to, like the reserve policy that we just mentioned, but other policies such as the gift acceptance policy that help govern the organization. So the treasurer, the CFO, the CEO, and the advancement committee are all going to work together on that gift acceptance policy. And the more they work together, the better off the health is of the overall organization. The treasurer's also, or the finance committee head, is also responsible for leading the launch of the endowment. So helping to write or oversee the writing of the investment policy statement, hiring an outside advisor or professionals, and holding the meetings to review the endowment performance and any changes in the market value. In other words, if your organization is hoping to maintain a board fund or especially an endowment, it must ensure that there are members of the board who take this very seriously. Otherwise, it won't get done, or the organization could get itself into trouble if there's weak oversight. So, as we said before, restricted endowments are regulated. So, the investment policy statement, how does it show the way for your organization? It's a critical document for any organization in establishing an endowment and also a board fund. It sets out the clear objectives and management policies to ensure that the fiduciaries, so those on the board who are fiduciaries, are accountable for the endowment supervision throughout the life of the endowment, which sometimes is in perpetuity. So, what are some key sections of the investment policy? It really is defining the purpose of the endowment, and it goes back to the discussion that we had earlier. When you're starting an endowment, it's really looking at what program or operational expense will the endowment focus on. So think of the school. An endowment may be entirely focused on supporting low-income students' needs, or it could be entirely focused on the building, maintaining the buildings, or it could be for the general purpose of the school's long-term resiliency. And so then it's a little bit more flexible in terms of what goes in to support the school, whether it's scholarships, whether it's tuition reduction, whether it's building maintenance, or all of the above. So you also need the roles and responsibilities. This section tells us who does what with respect to overseeing the endowment. What's the role of the finance committee, the role of the CEO or executive director, the CFO, etc., and the investment advisor if you're hiring a professional. We also want to see a bit about the investment strategy. How is the endowment invested in terms of, what is it focused on? How is it being reviewed? How often? And then it's also looking at spend from the endowment. What's the spend policy? And when will we take the money out? And how often? Is it twice a year, once a year, etc.? And then you're looking at how performance is measured. You want to be able to hold the endowment accountable for growth. The policy itself is usually signed off by either the chair of the board or the treasurer. And remember, this is a living document. The organization needs to refer to it periodically and also to ensure that any professional that it hires is following the policy. I know of one board member who told me that an advisor they hired to manage the endowment was investing outside what was stipulated in the policy. And when they were asked about it, the advisor said, "Well, you're making money, aren't you?" But we know that chasing returns, going after the highest yielding instrument, isn't always going to result in a good outcome or a good policy. And investors in volatile tech stocks will tell you that's exactly what can happen. So, when do you hire an advisor or when do you do it yourself or DIY? We'll start with DIY. If your organization has a small amount that advisors maybe aren't bidding on or expressing an interest in managing, then maybe it's too small to outsource and you want to manage that in-house. It could be also that, it's a small amount of money, so having it done by volunteers is not going to cause too much harm. And if it's a small enough balance, you could put it into one fund, one balanced fund. So typically it's 50% stocks, 50% bonds, and you put that into one brokerage account, and that typically shouldn't cause any issues. We really recommend that if you're doing it yourself, that you have a staff member available to monitor it. We really discourage board members managing it because they're not paid, they're volunteers, and they have terms on the board. So once they leave, you risk having it not managed or reviewed at all. I do know of one organization where the board turned over, the staff turned over, and they couldn't get access to the account for a number of months. They had no idea how much was there, had no documentation, and no real history of what happened. So that can cause a big challenge. So, we reviewed making sure they monitor it. If it's a short time horizon, that's fine too. But when do you hire a professional? Usually it's best to hire a professional when there's a consequential amount of money or the endowment or the pool of funds is restricted. And it's important that you manage it well and that you don't want to have to fire a staff member or a board member if it performs poorly, right? If someone's being a volunteer, it's easier to fire a professional vendor than it is a board member or a staff member for doing something that maybe isn't even in their wheelhouse, right? They were doing it sort of as a favor to the organization. The other time you want to hire a professional is when it's long-term money. We're talking 5+ years, and typically endowments are going to be either in perpetuity or they may be 20 to 30 years. The other time you want to hire a professional is when there's little to no experience of endowment investing on the board. Donors don't want to give significantly if they learn that a board member is managing it in his or her spare time, right? It's really important to have professionalism around it. So if you do decide to hire a professional, you may want to consider an advisor that is culturally aligned and really understands the community that your organization serves. You may decide to go with a local organization who has a grasp of your community's needs, due to their direct involvement and presence in the community, or you may decide to go with a national firm that has a, name recognition or may offer more bespoke resources, but they may miss local nuances. So it's definitely down to preference and information. You also want to hire someone that really understands nonprofits. That's important too. Any advisor you hire should be transparent about their fees, about their how they invest, about everything, and be willing to meet with you based on your needs. Be willing to train leadership on the endowment management at no extra cost, as well as really understand how you're going to grow the endowment and be able to connect you with the appropriate resources. And again, that's the least of what they should provide. So we decided to pull smaller and mid-sized endowments on their readiness for an endowment. And it was telling that 50% were evaluating options for their first endowment or board fund. It's a sign of the times, frankly, given the funding cuts and changing donor priorities and demographics. So it wasn't too surprising there that people were at least exploring it. We then asked if organizations felt they had a strong development or advancement committee to really systematically build, launch, and seed the endowment. That was interesting. 65% said no. So that is telling you really need kind of that three legs of a stool, the sort of willingness to explore it, the structure and strength of the advancement committee, and then the strength of the finance committee, which was another question we asked is, do you have a strong finance committee to oversee the endowment? These answers, people about 70% said, yeah, we do have a strong finance committee. Oftentimes it's easier to get, the CPA, the accountant, the auditor, the investment advisor to join the board. Sometimes it's harder when you don't have the skills, the fundraising skills on the board or the structure in place. All right, well, let's revisit the research study that we talked about in the beginning, that we discussed. I want to bookend it with why launching or growing an endowment can lead to organizational resiliency. So remember when we said that nonprofits with an endowment had 6 times more assets than a nonprofit without an endowment? This same study also concluded that nonprofits with endowments are larger in general and grow faster than nonprofits without an endowment. It's not just the assets that grow, it's revenues, it's contributions, and functional expenses on approved charitable activities. So that, that sort of adage of you got to spend money to make money In this case, it's true. These organizations were spending money to build the foundation of their long-term fundraising campaigns. This paper of note too, in this paper, it also found that nonprofit endowment funds have grown at about a rate of 11.7 per year, delivering investment returns of 4.7, which means the remainder there, 5% or so, is from contributions, which is interesting. And they are distributing about 5.9% of their AUM per year to support their charitable activities of the organization. So very, very interesting, and I hope supportive of your organization in considering starting or launching an endowment. Well, that concludes our session. If you'd like to learn more about how to start an endowment, please visit our website at fairlightadvisors.com/endowment guide, and you can access our free endowment guide and participate in a semi-monthly education campaign. You'll receive in your inbox just tidbits on how to start and maintain an endowment. Thank you very much.